Hi, in this video we are going to look at financial statements, mainly now focusing on the statement of comprehensive income, or famously known as the income statement. Now, the income statement is a document that is prepared for any business, small, medium, large enterprises need to have an income statement because its sole purpose is to check if the business has made a profit or a loss during the financial year. So we are going to look at all our sales, whatever it has cost us to make those sales, as well as other expenses, side hustles that we might have, any income coming in. We are going to take all of that into account and then check the net profit or loss for the year so that taxation can be calculated, as well as the owners can then see how much they have to share amongst themselves without destroying the business. So you can't take money from the business before salaries, for example, are paid. That's not good business practice. So I'll just look at some important notes before going into the format of the income statement, which is the most important part of this video. Income statements will start off with a line written sales. However, in most cases, we refer to sales because we do mostly the retail style businesses that buy and sell items. But for other businesses like us, tutorial businesses, we render services. So because we render services, calling that sales or money from there as sales does not really make nice accounting sense to us. Therefore, we refer to it as revenue, money generated from operations, or turnover. So don't be surprised. These are interchangeable synonyms that just mean money that is brought in from the main operations of the business. So if the business is selling, they will prefer sales. If the business is rendering services, revenue is usually preferred. And then in general, maybe if there's a mix, they might just refer to that as turnover. So it is important to know that at the beginning, or the heading of it, we will have income statement of comprehensive income. Then it will be written for the year ended. So we'll have the end date of that particular year. Now, this is very important because when preparing the income statement, it is important to note that we only record expenses and incomes that relate to the current financial year. Most years in South Africa, financial years, that is, start in March and then end in February of the next year. But there are other businesses like ours, it starts in July and ends in the June month of the following year. So any 12-month span can be referred to as a financial year. So it's important that before you prepare this document, you check on how are they recording their financial years, from which date to which. Then, any amounts that have been paid before time, prepaid, those ones must be excluded. You remove them from the calculations of this particular financial document. That if there are any prepaid expenses, we made some payments to expenses of next year or whatever the case may be, we remove them. Also, if we've received any money for next year's operations or any advanced payments, we need to remove those ones because they do not refer to the current financial year's profit. Then we also have the opposite side of the spectrum, outstanding, although we more refer to it as accrued. So any accrued expenses or incomes must be included. What are those? Those are outstanding, meaning we were supposed to pay maybe the auditors a certain amount of money, but we haven't. Or we were supposed to pay salaries, but we haven't paid those salaries yet, but we are preparing the document. Therefore, we must include the amount that needs to be paid for the financial year. Not just the one that was paid, but what is supposed to be paid in that financial year for the particular item. Then also, as you prepare this one, we would need to take a look at some errors that might have been made or any omissions, things that have been added that were not supposed to be added. So we have what we call adjustments or year-end adjustments. So we'll talk about those ones separately, one by one, as each adjustment has its own tricks to it and ways of approach. Then, now looking at the format, we've already talked about the sales, then we will record the sales amount here. Remember, should there be any debtors allowances, we will subtract them. Also, if somebody has returned some items and then we gave them their money back, or should give them the money back, we need to remove that one from the sales for the year because the sale has been cancelled. Then, after we've determined our sales, correct sales amount for the year, We are then going to look at our cost of sales. So if returns were made, they usually also affect the cost of sales. But other than that, we can get that amount. Sometimes we also use what we call the markup, that once you know the total sales, you can then look at your markup. But in that also, be careful of any discounts that were made. All right. Then the first two sections are done. We are going to look at what we call the gross profit. Now, importantly, please, even for those that especially do maths literacy, gross profit is the amount of sales made minus the cost of making the sale. So what we call cost of sales. For accounting situations, for cost accounting, it usually refers to the cost that it was applied for the business to get the items to the business and then store them and then sell them. So that is pretty much what we look at cost of sales. But it's usually more of the cost price of buying the goods, carrying them to the business. So the issues of electricity, depreciation of equipment and all of that is dealt with much later. So when a business says we've made a gross profit of 10 million, it does not mean they have 10 million to give to the owners to be spending and going to Dubai. No, it just means that before they pay any of the operational expenses like electricity, salaries, maybe rent, that's the amount of money they have. So it's not actual net profit. Now, that's what the income statement does for us. It separates the gross profit from the net profit because it's important for us to see some businesses are making a lot more profit from side hustles than the actual operations. So that kind of business should leave the main operation and focus on the side hustles because it's more profitable. All right. Once that is done, that's the one I was referring to now, that we are going to list other operating incomes. So that's what I was referring to as side hustles. Any other way that the business is making money will be recorded in this section in a list. So for example, we have, if there's a tenant, they will be paying rent. If we are maybe providing some type of service externally and then we get commission income, or maybe selling stuff on behalf of somebody else and they pay us commission, it will be here. It has nothing to do with our main operations. Also, if there are bad debts or credit losses that have been recovered, they will be here. And if we sold items, assets, equipment, or cars and made a profit from that, it's additional income. SARS will want to tax us on that amount. Okay, then this box in accounting means that you add up everything that's here, the total is written at the top. So we are adding each and every one of our additional incomes and then writing the total here under other operating incomes. So that is then set. Once we are done with that situation, we are going to add the gross profit and the operating incomes in order for us to get what we call gross operating income. So gross operating income means that the total income that we have gotten from all operations of the business. Main operation, side hustles, rental agreements, and any other commission or people who had previously ran away with our money or were not able to pay us, and then after some year or years they are then able to pay us, which is what we call bad debt recovered. Those ones also come in here because usually they are written off from our books. Once that is done, we are then going to consider our expenses. So we are going to have our salaries. So we start with the salaries case. So our salaries will come in here. So remember, these are examples. So some companies will have additional things. We will have our water and electricity coming here, and then we have depreciation on equipment plus vehicles coming here, or any other resources that we have that depreciate. Then we will have our bad debts. So people who are making us lose money because they are unable to pay us anymore. It's money we were expecting, but we are unable to get because the court has ordered that they are insolvent, unable to pay. Even if they sell everything they have, they might give us maybe 30 cents on the rand, or which means that 30% of the money that they owe us will be received. The 70% cannot be received. Because what happens is that when you are declared insolvent and you sell up all your assets, liquidation, then they are going to check your total liabilities. How much do you owe everybody in total? Then they look at how much they made from selling your assets. So if that money is 30% of what you owe the people, each and every one of those people get 30% of the money that they are owed. So to us, that applies as a fair solution. Rather than giving person X all the money that you owe them, and then we say to person B that, there's no money left over, sorry, you will have to write off everything. So 30% for everybody works out fairly. With that said, we add up all the expenses that were made, sundry expenses, stationery, any other things that we spend money on for operations. We add them up here. Then the total is written at the top with a negative that shows that it's an expense that needs to be separated. Similarly, with the cost of sales, we had that it needs to be subtracted. So the brackets here are referring to subtraction. All right. Now, once we have this one, we have the total money we made from incomes, the total amount of money we spent on expenses. Therefore, we are now able to add these two together in order for us to get what we call our operating expenses. So let's do them like this as well. So we take this, add together, and we get what we call our operating profit or loss. So operating profit or loss, I'm referring to it here because it could be a profit, it could be a loss, but in most of our accounting, especially high school accounting, we deal with profit-making businesses. So this amount will be usually positive or always positive for the high schools. University levels, it can change. Then once we have that amount of money, we know how much profit we have before considering any financial investments, any financial liabilities that are there, like loans, and financial investments could refer to fixed deposits. So the other amount now will come from interest income. So that's mostly from the financial investments. So interest income is usually interest that is charged or received from fixed deposit investment or any positive current account balance and other types of financial investments that we have. So in most cases, we are used a lot to the fixed deposit, but we might get other types of interest there. Please be aware of those ones. Anything referring to positive bank balances, especially if it's a current account, it might receive positive interest on it. So it's an interest income amount. Then once we have the interest income, we add it to the already made profit to get what we call profit before interest expenses. Now, interest expenses comes up next as interest that is charged on loans, bank overdraft, or maybe by creditors. So any loan that we have with the bank will be accumulating interest. So the interest that's there will be removing money from the business because we need to pay for it for that current financial year. So usually our interest is calculated for the whole year. Then we are able to record it here as interest expense. If we have a negative balance in the current account, then we will be charged interest on that. We call it an overdraft. So there will be interest on the overdraft. It should also be added here. So it's not just the loan, but it could be the loan plus overdraft amount of interest. Then after that, we are going to subtract because it's an expense. We subtract that from the profit we had before. Then we get what we call net profit or loss before taxation. For grade 10s and 11s, that's where it ends. It ends as profit or loss or just net profit. But for the grade 12s, university level, we know that SARS, you can't operate a business without paying SARS. So in that case, this is called net profit or loss before taxation is calculated. So if this amount is positive, you will be needing to consider the taxation that needs to be paid to SARS. If it's sufficient, you must give it to SARS. Then taxation will be calculated after that as a negative amount because it's an expense. So usually our taxation is calculated as a percentage, 28%, 30% on the net profit, but the question will give you how much or how calculations should be done. So just pay attention to that. Then we will calculate the percentage on this amount, subtract it, and then finally have our net profit or loss after tax. So that is the profit that the shareholders, the owners, can then start sharing amongst themselves, because it means that after having paid everything that needs to be paid, this is the money left over for equity. So it will add to the owner's equity. Then they can decide what to do with that particular amount. If we're dealing with the grade 12, you know that this is when they decide how much are they retaining and how much are they giving to the shareholders as dividends, which means that they will receive it in their bank accounts. But the other is retained in order to grow the business. Maybe if we are planning to buy assets next year, repay the loan, we can use that particular money just to make the business more valuable. So that's what we have for the income statement. Take homes, income statement, you must know the format. In accounting, the format alone and knowing what to add, how to add, what to subtract, where to put the totals can earn you the 50 marks or 50 points or percent of the points. The issue is that accounting is about recording and following what we call the GAAP principle, generally accepted accounting principles, to record things correctly, because mistakes happen. We know this. That's why we don't penalize too much for mistakes in accounting. We know mistakes happen, which is why we have a whole branch of accounting called auditing, especially for the section of internal auditors, that people are responsible just for making sure, that's a whole career of making sure that the books are in order, recorded properly, any mistakes that were made are fixed. Because as a bookkeeper, we know that mistakes do happen. Sometimes you don't even have all the information you need to prepare the financial statement, which is why we have year-end adjustments, that after the initial trial balance was prepared, we found that there are some mistakes that were done that need to be fixed. So that is what we have, and we will see you again for the next video on the balance sheet or statement of financial position of the business. But so long, you can send us any comments that you have. Also, let us know what topics you would like us to cover, especially with the adjustments. Let us know if there's any adjustment that is troubling you, so we can start on that particular adjustment and just explain to you how to tackle it. For example, we know loan adjustments, rental adjustments that have some changes during the year in percentages, especially what quite problematic. Trading stock, deficit and surplus also can contribute to the incomes and expenses of the particular business. So let us know in the comment section. We'll cover other